Hello and welcome. My name is Jonathan Lopez, and this is the Peachtree Case A for the Finance 139 class and for Dr. Shiroki. We start out the case by calculating out the expected return of the T-Bond, TICO, Gold Hill, and the S&P 500. And ideally what we're trying to do is decide what the highest expected rate of return is for the four alternatives. That way, based on these returns, we would see what the best potential investment would be for an outside investor. And after we calculate these expected returns, we would then go to calculate standard deviations and coefficients of variation of the returns for the four alternatives. And both the standard deviation and the coefficient of variation for T-bills will be 0 because the expected return will always be 0.08. The coefficient of variation for TICO is 0.868, and the standard deviation of returns is 11.72, as you can see from the chart. Continuing on, Gold Hill is 1.033 coefficient variation, and their standard deviation of returns is 9.1%. And just so we're clear, this is all constructed and calculated by doing the return minus the mean raised to the second power times by the probability of the return. And this is all indicated here on the table. Continuing on, we have the S&P 500, which we see that the coefficient of variation of returns is 1.095, and the standard deviation of returns for the S&P 500 is 16.4%. So as we see the final results above of the four alternatives, it all varies, and what we're really trying to find out is what the standard deviation, the coefficient of variation means, and whether one or the other is a better measure of risk. And I believe, and I'm sure many would readily agree, that coefficient of variation is a better measure of risk because it's a solid indicator of the correlation of risk and return. For example, the lower the coefficient of variation, the less risk there is, and therefore return should be expected to be lower than if an investment was significantly riskier with a higher coefficient of variation. So the Peachtree case here is really trying to get us to understand different types of risk, including volatility and the reaction it has to expected rates of return. So risk reduction is very possible, and it's due to the fact that both TICO and Gold Hill have negative correlations. The ability to reduce risk is possible because these stocks will now move in opposite directions when compared to the market. So this would diversify our portfolio in the sense that if you were to take more stocks that had betas of 1, for instance, that are correlated mostly with the market, or readily move in the same flow of the market, to undertake a stock with a negative correlation in your portfolio would offset that risk, reducing your amount of overall value or overall returns possible, but also reducing your amount of loss as well. Now, changes in expected rate of returns are shown above, and the way we did this is that we weighted standard deviation and portfolios containing Gold Hill and TICO at about 75%. And it increased the weights of either stock, create a significant imbalance, and increase the standard deviation of the portfolio, while simultaneously increasing risk or volatility. As you can see, the average return for TICO has been moved to 0.12325, Gold Hill is 0.09975, and the standard deviation is 0.06886 and 0.0448 respectively. Referring back to the Peachtree case, when considering a portfolio consisting of $10,000 in TICO and $10,000 in the S&P 500 fund, would the portfolio have the same risk-reducing effect as Gold Hill TICO portfolio as considered in earlier questions? And the answer would be no, they wouldn't have the same risk-reducing effects because they actually move in the same direction. They both have a positive covariance around the same number, and because of this, they have the same risk diversion aspects or risk aversion aspects as the other. That means, as we said previously, that since they move in the same direction, that they are incapable of offsetting the loss or gains that each other makes. They're increasing the risk and increasing your returns, but with that high risk, there's also the high likelihood that there could be losses incurred as well. And to substantiate the point, what we did is we created a table, as you see here on the screen, and we ran another covariance and another standard deviation as based on our constructed portfolio and the assumptions created. And what we did come out with was that there was a new covariance of 0.031804 and a new standard deviation of 15.23%. So since standard deviation increased, the risk and return possibly could increase as well. Covariance, however, they move in the same direction, and since that is a positive covariance, that just furthers the point that they will have the same risk aversion aspects. And although the risk is greater and the returns are greater, the losses are there and very capable to happen as well. Moving on, we're going to talk about different types of risk. This is going to be systematic risk, unsystematic risk, and also total risk. Unsystematic risk, or risk that can be diversified away, is risk that is specific to a company, whereas systematic risk is the risk of the entire market, and therefore non-diversifiable. However, what's all-encompassing of these two aspects is the best measure of risk, which is total risk, and that is seen as a function of total risk equals systematic risk plus unsystematic risk. Now that we understand some of the types of risk, we're going to go ahead and plot some lines. And what you see before you here is TECO, the T-bond, and Gold Hill, as well as the regression lines for these 3 points. And what we're really trying to show here is that the regression line and the actual returns has a distance or separation between the plot points and these lines, and that represents the standard error of each model. And the further away from the model the line is, the less valid the model is at predicting returns. So for example, if the regression line falls directly on the model would be accurate. And that could be clearly indicated by looking at the T-bill line right there in the center. That's at a strong 8%. You could see how the regression line and the T-bill line are directly on top of each other, meaning that there's a strong and accurate predictor of returns to come in the future. The next set of lines we're going to plot is going to be the security market line, and this encompasses the S&P 500 as well as TECO and the 10-year Treasury bond rate. What we did here is we did 3 CAPM equations that brought us out to 0.08, 0.122, and 0.15 respectively. And based on the graph above, we drew out the market line. We plotted the point for TECO being at roughly between 12 and 15%. And we see that TECO, since it is above the security market line, would be deemed as undervalued currently by the market. Now that we see that TECO is currently undervalued, what happens when there's fluctuations in the market? And in this case, what we did was we increased inflation by 3%, and we saw that the CAPM return reduced to 13.4%. And continuing on, if we were to increase the risk-free rate from 7% to 8%, the market risk premium, from 7% to 8%, the required rate of return would then increase to 12.8%. Now, some of you might be thinking that the market is so efficient that an undervalued or underpriced stock is almost impossible. And the reason behind this is because securities are rarely substantially mispriced in the marketplace, and really no security analysis is capable of identifying mispriced securities with a frequency greater than what might be expected from random chance. So when we kind of scroll down and go to Jake Taylor's question or concern about the EMH when he considers adding to his staff of security analysts, we say that Jake should not take into account when hiring a staff because since it's a random chance, he might increase his chances with better staff. Now lastly, we're going to talk about a decrease in long-term debt. And a decrease in long-term debt would overall decrease the overall risk, decrease the beta of a stock. It would also decrease the required rate of return on that stock. And by decreasing this long-term debt ratio, TECO would see an increase in stock value and possibly therefore could see an increase in the amount of investors interested in the stock at that value or at that price in the current market. Now I'd like to say thank you very much for watching and have a nice day.